and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by, well, I was going to say our global market specialist, but really our global economic specialist, Deepika, Dayal, and Giovanni, Zanni. Okay, it was all about the data this week, so very fortunate to be able to have you with us, Deepika. Clearly, the market was laser focused on the April CPI print. We're recording this on Wednesday, straight after the data. So I don't think you've had too much time to digest it, but perhaps we can just go through your kind of early thoughts of today's print and what it means for the Fed.
Thanks, Imogen. And yes, this week was all about inflation data, at least to begin with. We got the PPI yesterday that came in a bit stronger than expected. Today's data, the April CPI report, however, was as welcome a development as the March CPI report had been inconvenient, at least from the Fed's perspective, even so from a forecasting perspective. However, if we look into the details of the report, this is one report, which is following gains of 0.4% in the core CPI over the last 3 months. So it's unlikely to foster enough confidence for the Fed that they have a good handle on inflation and inflation is sustainably moving back to their 2% target. 1 month's data point does not make a trend. If you were to look at the rates of change, the 3-month annualized rates of change or the 6-month annualized rate of change for the core CPI, both those metrics are still running with a 4% handle, something we haven't seen since late last year. So from the Fed's perspective, at least optically, this is a step in the right direction, but this is not the war has been won situation. Even so, looking at the details of the report, the ones that we've been able to process over the last couple of hours, it was a good report. We saw moderation in shelter costs. There was continued weakness in core goods prices. They're still working in the disinflation territory. We saw some moderation in core services ex rents numbers as well. Overall, this is a good picture. This does imply a 0.2% gain in the core PCE deflator, which is also the Fed's preferred inflation gauge. However, the Fed is really looking at trends. While they're data dependent, they are not one data point dependent. They're looking at what's happening to inflation on a trend basis. And for what it's worth, our own estimate of a 0.2% increase in the core PCE deflator for April translates to a 2.7% gain in the core PC rate on a year-on-year basis. That's just a touch softer than the 2.8% prints that we've seen in February and March, or the 2.9 that we saw in January. So the speed at which inflation is moderating is probably not good enough for the Fed at this point, at least to start suggesting that they can build in expectations of rate cuts just yet. For what it's worth, our own expectation is that the Fed won't see meaningful improvement in inflation prints up until late Q3 or early fourth quarter of this year. And we would start seeing, we expect to see the first cut in December with a 25 basis point reduction in the policy rate later this year. There are a couple of other things just besides the April CPI report that the Fed will be watching. Up until now, base effects have been a big factor in pulling down inflation, or at least causing inflation to moderate since the start of the year, despite the heavy prints that we saw in Q1. However, base effects are going to start turning less favorable over the next few months. So if we were to look at both core CPI or core PCE in Q2 or even early Q3, these numbers will look like they're stalling, even though the monthly prints would show some progress on that front. So from the Fed's perspective, it would be wiser to wait because they've been burned before from inflation and not reacting enough. So at this point, we believe that patience when it comes to inflation and not reacting to one data print would be the way to go.
The market obviously reacted very favorably to the first kind of inline print after a number of months of stronger than expected data. But one of the things that drove, I think, the kind of extended market reaction was that this kind of inline CPI print also came off the back of weaker than expected retail sales data earlier in the week. Do you think that weaker retail sales kind of complicates the growth picture for the Fed at all?
It could, but if we were to look at the retail sales report that came out this morning, it's showing some moderation. But given the strong base of Q1, we could still see an above 2%, close to 3% handle on personal consumption in Q2. Any slowing that we're expecting in consumer spending would probably be a more H2 characterization for the economy rather than Q2. So at this point, we think that the Fed would stay focused on inflation rather than the growth picture. We saw non-farm payrolls slow a bit in April, but even so, it still reflects a fairly steady labor market. So the economy is still in a good place. Our own house call is that we see some slowing ahead over the course of perhaps this quarter or later on in Q3. However, from the Fed's perspective, their focus, we believe, squarely remains on inflation, and they want to see further progress on inflation before they can even consider easing. And while we're talking about growth, we got labor market data in the UK this week.
Yeah, I think as ever with the labour market data in the UK, there's so many kind of different numbers that there was sort of something for everyone in this week's print, and you could find enough, I think, to justify whatever your prior narrative was. For me, there was a couple of takeaways. On the more dovish side, or kind of working in the BOE's favour when it's thinking about how soon it can cut rates. Firstly, and this is what was really driving the markets, I think, not that we saw a particularly big market reaction at all, but we did see a little bit about performance of UK rates, and I think part of that was about this, the BOE's kind of preferred gauge of wages, this private sector regular pay growth 3-month year-over-year number came in at 5.9 versus the BOE's projection of 6.0 for Q1. Of course, that's a projection that it had revised up just a couple of weeks ago from 5.7. But nonetheless, for those that felt like Bailey's message was, we will cut rates as long as the data is in line, or we will cut rates in June, I should say, as long as the data is in line, then this was clearly a kind of hurdle cleared from that perspective, with the data being broadly in line, marginally below what their projections showed last week. The other sort of good point for the BOE is that the employment data, although we had some upward revisions to the PAYE numbers, they showed kind of continuing deteriorating trends on the employment side, which in theory should lead to alleviated pressures for wage inflation further down the line. Against that, though, a couple of points I would highlight is that on the private sector regular pay growth measure, although Q1 marginally undershot the BOE's revised up projections, our base case is that Q2 will marginally overshoot the BOE's projections, not by much. Ross, our chief UK economist, has 5.16 versus 5.1, but still, to the extent that everybody got very excited about a tiny undershoot in Q1, that we see that being offset in Q2. The second point is that, although the private sector regular pay growth was marginally below expectations, actually the headline average weekly earnings number, so overall wage inflation, was still up more than expected. And although the BOE has been quite focused on that private sector measure, ultimately it's kind of economy-wide total wage inflation, which is going to exert upward or downward pressure on domestic prices, and therefore CPI inflation. And then finally, although the employment data leaned in a more dovish direction, there was lots of talk last week at the Monetary Policy Report meeting about just how much uncertainty there is with the data. And so although in theory it should act as a leading indicator and give the BOE some confidence that persistence or persistent pressures are receding, perhaps they place a lot less weight on that at the moment than they otherwise would. So overall, a mixed set of data that I don't think made June materially more likely than we were, but that's kind of been reflected in market pricing that didn't really move all that much on the day. I think now the key data to look towards is clearly next week's inflation, and within that, the service inflation print. We've heard from a couple of MPC speakers recently, particularly those in the majority 7, that service price inflation number is the kind of key measure of persistence for them, because of the uncertainty with which wage inflation might be passed on to higher prices or to the consumer ultimately, because of concerns around the strength of demand, and therefore firms might be choosing to kind of squeeze margins rather than pass on higher prices. And so they're really seeing service price inflation as the key indicator of persistence. And we will get that next week. So all eyes on that, really.
And since you talked about expectations about the June BOE meeting, June versus August seems to be the key debate at the moment, but you're still sticking to August as your base case. What's the rationale?
Yes, I think I've said it on this podcast before, but we have been debating, well, previously kind of May versus June versus August, far too much over the last couple of months. And I think we've wasted far too much time talking about when that first 25 bip cut will be. But nonetheless, it's still kind of dominating our conversations now. We still think August. I mean, it's a close call, to be clear. It's not like a super high conviction view that we think they go in August. But there's 3 key reasons that I think that have kind of been reinforced this week of why August, I think, seems more likely at the margin than June. First one is that although they will have the April wage data by the June meeting, and that's the key wage setting month in the UK, we also have uncertainties around the national living wage, and that kicks in April. So April really is the key month for the wage data, and we will have that by the June meeting. But as this week's labour market data showed us, prior months can be subject to quite sizable revisions. And so although they will have the first look at April's data, they won't have had the revisions until the August meeting. And although most of the commentary around the uncertainty in the labour market data at the Monetary Policy Report meeting was around the labour force survey data and the problems with the collection sample, there was still reference to the fact that there is quite significant volatility month on month in the wage inflation data, and that creates makes it difficult, I guess, to place too much weight on any one print in any one month. So I think it will be important to see the revisions to the April data and not just that kind of flash print that we will have by June. The second, not to overstate the importance of monetary policy report meetings, I do think that the fact that August will be a quarterly meeting with updated projections give the MPC a opportunity to really dig into the data, how that changes their projections and their judgment of persistent inflation. And importantly for the BOE, it also provides them with a better communication platform. They don't have a press conference at every meeting, and therefore combining the ability to, refresh all of their projections and communicate their monetary policy stance better, both to markets and to the public, I think is important. And finally, although we had a kind of incrementally dovish shift in the vote split at the last meeting with Ramsden moving into the, rate cutting camp, so it went from 8-1 to 7-2 in favour of keeping rates on hold, which in theory puts you, quite relatively closer to finding a majority. You now only need to find 3 more voting for a rate cut for that to be the preferred option. I think it's still quite difficult to imagine a majority for a rate cut being formed without the chief economist, Hugh Pill. And we've heard from him a couple of times recently, and in none of those kind of interactions has he sounded particularly dovish. He said in his speech a few weeks ago that for him, the hurdle for changing his assessment on inflation persistence over the coming few months is relatively high. And he said that at the end of April. And then this week, he said that he would it would be appropriate to consider bank rate or the level of bank rate through the summer, Now, we spent a lot of time debating what through the summer really means and if we're ever actually going to see a summer in London. But nonetheless, through the summer, debating, the level of bank rate through the summer doesn't sound like someone who's particularly eager, I don't think, to vote for a rate cut as early as June. So we still favoured August. Of course, it's not a super high conviction view, and the BOE, as we know, are going to be very data dependent, and we've got lots of data still between now and then. Like I said, next week's CPI, we then have another month of CPI just before the meeting, and another set of wage data. So still, June is very much live, but just not yet our base case. For me, though, I think the market's kind of obsession, as I sort of alluded to, with this June versus August timing is somewhat missing the wood for the trees. The key message for the BOE last week and since then hasn't been about trying to guide the market towards a precisely pricing in the right start date. It's much more about the market not pricing in enough easing overall. And actually, from a real economy perspective, given that bank rate mostly works through the mortgage rate channel, and the rates that mostly affect that channel are the kind of 2 and 5 year swap rates, actually it's much more relevant for the BOE that the market is pricing in enough easing over that time period than it is, over the next 6 to 8 weeks. And I think that was really the key message from the minutes last week. So I think Bailey kind of gave the green light to that part of the curve, sort of out to the 2 year point, let's say, flattening from here as we price in more by way of rate cuts, but then perhaps steepening thereafter as the market kind of digests it. Still lots of supply and term premium returns as a result. But we've talked about that lots on the podcast before, so perhaps we can switch over to the Euro area now, where we are kind of closing in on that June potential cut date. With every week that passes, it feels like there isn't much that could now derail the ECB from cutting in their June meeting. Is that the right assessment, Gio? Is there anything that could derail a June cut now?
You were discussing the kind of debate in the UK, and I think that there is less debates in the Euro area. I mean, some ECB officials have mentioned the June cut almost as a fait accompli now, so meaning that there's very little uncertainty. And frankly, it makes sense, because if you look at what has happened in terms of inflation since March, it's definitely in line with the expectation of the projection of the ECB that were consistent with a cut. If you look at the growth development, GDP growth development as well, I mean, we're seeing some recovery, but that's the minimum that's actually needed to justify only a number of rate cuts that were implied in their March projections. So really, there's no reason to pull back on rate cutting intentions and no reason to change the narrative. We have been highlighting like 3 main risks, I mean, since several months now, that could derail potentially not just the June rate cut, but also the whole story in the Euro area. And the first one was about wage dynamics. As we know, I mean, the ECB used this kind of story for already last year, saying that we might have to be cautious because of the risk of second round inflation dynamic effects and this kind of wage inflation spiral, etc. Well, actually, when you look at the numbers, they are coming down. They are in line or even slightly better than what the ECB had expected. We have some data next week on the 23rd about Q1 negotiated wages that have been used by Lane as the main indicator to be sure that they could go ahead with rate cuts. And frankly, I think that they will be down again to something like 4.3% after 4.5% in Q4. But I don't think that's the main story. And I don't think actually that any number, except for like a huge surprise in one sense or the other, would change the story, because we have some forecasts. We had some forecasts this morning from the European Commission again confirming this idea that wages are on a deceleration path. We have all these wage trackers, leading indicators that are telling us that wage dynamics are moderating already. And if you look at the lead of these indicators, it's normally 6 to 12 months. They're telling you basically that wages will go down to 3% in the coming years. So, I mean, we are definitely there or even below what the ECB had suggested. So I don't think that really this wage story is anymore a question, and I think that the ECB is much more relaxed about that, and it makes sense. The second risk, which is more relevant, more present also because that has been the surprise of the past few months, and it's the U.S. economy exuberance and the fact that the Fed has, moved to a more cold feet kind of position and more cautious position. And yes, it's true, and we've said it as well, that of course less rate cuts or change in dynamics in policy in the US has an impact on Europe. Basically could delay or reduce the number of rate cuts. But it's also true that there are other things to consider in that, and the fact that you have a tighter policy through the long end of the curve has an impact on policy. And some ECB officials have suggested that actually it should imply more rate cuts from the ECB. And then the fact that if you look at the main channel of this impact, it will be the exchange rate. And actually, we haven't seen much move on that. Our FX strategists are suggesting that this is due to other factors, and of course I agree. And it's related to the fact that the growth differential is becoming smaller. That the current account in Europe has improved a lot. There's a big surplus now. So the effect is not really there, and the reason to have a euro dollar moving towards parity is not that strong anyway. But okay, this is something that we have to consider. I would say it will probably argue for a little bit of caution at the margin for now from the ECB. And the third risk is the geopolitical situation. Very uncertain, has increasing uncertainty, definitely from a general perspective in the last few months. But at the same time, the impact of that on the macro indicators that should have an impact on the economy, there's no real strong sign. I mean, energy prices haven't moved that much. Uncertainty indicators haven't moved that much. Supply chain bottlenecks, etc., have actually continued to improve despite what has happened in the Red Sea, etc. So, I'm sure that this is a very important risk, but so far so good in a sense. Although I don't know if it's the right word given the geopolitical situation, but it's definitely not what we've seen in 2022 in terms of impact there. So, and just to conclude, overall, new shocks will certainly appear, and then you have the U.S. election, so the situation will be uncertain, going towards the end of this year and next year. Having said that, the central scenario that we penciled in last year, like in September already, saying that the ECB had to cut rates already in H1 of this year, that around 100 basis points was the right amount for this year and maybe some more in 2025, is still basically there. I mean, we've lowered a little bit the amount of cuts because of the US side to 75%, our central scenario. So 25 basis points, 25 for each projection meeting this year, so June, September, and December. But if things change a little bit on the US side, if you have positive surprise on the other risk, I mean, I still don't exclude an October rate cut, and with more in 2025, and the first rate cut definitely happening in June.
All that time we spent at the beginning of the year defending why the ECB could go ahead of the Fed, and now it seems we're finally going to get there. All right then, that's probably enough for today. Thank you both for joining me. It was great to have an economist perspective with all the data that we've been having recently, and of course with central banks in data dependent mode, it's very key that we're up to date on all of that. So thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.